Hi everyone, welcome back to another episode of Fundamental Analysis, and today we'll continue our talk about investment banking infrastructure, and this is the last activity we'll talk about, which is private equity. We talked about brokerage, we talked about different types of activities like asset management and investment banking and research, and today we'll talk about private equity. Private equity is basically we talk about privately held securities or privately traded securities, and they're closed. This is a kind of a company that's not really open in the market. It's not open to everyone to buy and sell, and that's why I call it it's private. Okay, and why is it equity? Because basically, as you can remember, a balance sheet is made up of assets financed by liabilities and equity, and here we actually buying and selling these stakes in equity, and that's why they're private, because they're privately traded or closed companies. How do private equity firms make money? They make money simply by buying companies that they think they're undervalued and try to manage them a bit, try to increase or grow their value, maybe try to help them grow their business. Then at the end of the day, they need to have an exit strategy. Actually, they should have the exit strategy as the moment they decide to step into this type of investment. And usually it takes about, let's say, between 3 to 7 years to exit. So they can actually invest in public companies in the market. They can take these companies private, they can take them private, or they can actually buy privately held companies. They can do this by buying direct ownerships in companies, or they can actually buy indirect ownership in companies. Direct ownership meaning that they buy, let's say it's a company called XYZ, this is the private equity company, they can buy a stake in a company that's in the market, it's called ABC. This is just direct ownership. Or they can buy their stakes indirectly by setting up a private equity fund. Let's say the company, the private equity, it's XYZ. They actually create a fund, and this fund would in turn actually buy the company, the target company, which is ABC. So this is indirect. The fund here is not all the XYZ or the private equity firm's money. They actually have other clients with them that they actually participate in the fund, sort of mutual fund, but it's not really mutual fund because it is actually set up for the specific purpose of buying closely held companies like ABC here. How they make money? They make money through performance fees, but here we have something called the hurdle rate, and they have actually they can only get paid money if they generate a rate of return that's higher than the hurdle rate, which is the minimum rate that they can actually make. The problem here with the private equity firms is that they have investments in it's not really liquid investments that they buy. They're not liquid because usually they remain investing, fully invested in these companies that they buy for 3 to 7 years. That's what we call the vantage point, and they don't really sell that soon. It's not like the mutual fund where you can buy and sell on a daily basis. But here you have to have the exit strategy. You have to have the exit in mind. So what do? They actually can different types of exit strategies. They can actually sell to a strategic investor, or a strategic investor, basically the company that's working in the same business, or they can sell to another private equity like a financial investor, or they can go exit through the market and as part of the IPO process. The structure of the hedge fund could be, or the structure of the private equity could be structured as a hedge fund, and they can actually can be regulated a bit differently. Okay, let's look at an example from the market just to explain things a bit better. Let's say we have a company, not actually it's a real life example. So we had a company called EFC, Egyptian Fertilizers Company, and this company was actually owned in part by a private equity firm called Kala Holdings, okay, as a private equity. And this private equity, actually, they have to think of how they can exit. So they had this stake in EFC, which is a fertilizers business, and they were thinking of exiting the business down the road. And after they bought the stake in the company, they were thinking, okay, let's first go for an IPO, go public. Let's float the stock of EFC in the market. Okay, let's list them on EGX, Egyptian Exchange. But just before they were about to go public, they were approached by another private equity firm. Here the company was called Abraj Group. This is a UAE-based private equity firm, and they approached Kala Holdings and said, okay, we actually are interested in buying this company, the fertilizers company, EFC. So Kala Holdings, now first they were thinking about exiting through an IPO. Now they're thinking about exiting through the sale to another private equity, another financial investor. Now Abraj Group has EFC. They own EFC. They also have to think about their exit strategy. What are they going to do? They have also three options: go through an IPO, sell to another private equity, or sell to a strategic investor. Actually, Abraj Group, in this case, they went for the third option, selling to a strategic investor. At that time, it was Orascom Construction Industries, or OCI. At the time, they had just sold their cement business, and they were investing now in fertilizers. And they were actually bought EFC, and now it is part of OCI fertilizers business. So they have different types of exiting, as I mentioned. You could go through an IPO, sell to another PE firm, or to a strategic investor. Thank you very much for you listening to our private equity firm. I'll meet soon in the next episode. Thank you.